Hello and welcome to Radio Pete's Wealth Talk. My name is Pete Williams, the host of this program in which we talk about wealth, building wealth, saving wealth, and ultimately distributing wealth. I thought what we would do today is talk about a very hot topic, and that is the stock market, which, if you didn't know, has entered bear market territory. Here's an article from just this past Monday, June 14th, and from Money Watch. The stock market's tumble has put the S&P 500 into a bear market, which is defined as a decline of at least 20% from the most recent high. The most recent high was in early January of this year, and as of Monday's close, which was down 4% for the day, this put the S&P 500 21% below its peak in January. So what to make of all this? There's a lot of things that the stock market and the bond market are trying to digest. We all know that we have a high rate of inflation. If you haven't heard that, you certainly have seen it in your local grocery store as well as your gas station. And we've got the Federal Reserve trying to battle that high inflation with raising interest rates and trying to do that without going into a recession. We've got high energy costs. We've got the war in Ukraine. We've got China backlog. So what to do, what to make of it? What I hope to accomplish in this very brief video today is maybe to just set people's minds at ease, because I think the most important thing to do right now is to remain calm, not panic. And maybe I can help you along that path with a couple of things I just want to show you real quick. Here's a quick graph of the major indices. The NASDAQ is down about 30%, the Dow Jones 16%, and the Standard & Poor's 500 21.3%. We've seen these kinds of numbers before. What I'd like to do is just go through a little bit of history, a little bit of math, and help figure out what is our next step as investors. So now that we know we're in a bear market, we might very well ask, how long does a bear market normally last? Here we're going to talk about averages. Remember one thing about averages. They are just that. They're an average. So there are periods of time when bear markets have lasted shorter, and there are periods of time when they've lasted longer. But the facts are that bear markets, first of all, take 13 months to go from peak to trough and 27 months to get back to break even. So right now the S&P 500 has fallen 21%. The average in a bear market is 33%. The worst bear market since 1945 was the 2007-2009 bear market. The S&P dropped 57%. Now let's look at it on the bright side. Number one, we recovered from the 2007-2009 bear market, and we recovered substantially, and we'll see that in a moment here. We went on to new highs, and by definition, because January 6th was the new high in the S&P 500, it has never been a bad time to own stocks up until the high of January. And unless things have changed fundamentally, there's a good chance that that will happen again, that stocks will go higher at some time. Another little bright news, history shows that the faster an index goes into a bear market, the shallower they tend to be. So historically, stocks have taken 251 days to fall into a bear market. That's from high to bear market territory to a 20% decline. And when this S&P has fallen at a faster clip, the index has averaged losses of 28%. So remember, we have fallen into this bear market very quickly, less than 6 months, from January 6th to just this week. So we're way ahead of this fall, this average fall of 8.3 months. What that can mean, doesn't necessarily have to be, but on average, when you have a quick fall you have a quick recovery and less of a loss. That's not to say that you can't have larger losses. Just to put it out there, the longest bear market lasted 61 months, ended in March 1942, and stocks were down 60%. So it's worth taking a look. Let's go back the past 40 years, 41 years, uh, and we will study this period because we're talking a lot about what the economics are of our current status with regard to interest rates and inflation. And there's a lot of talk about a like period that happened in the late 70s and early 80s, the so-called Paul Volcker years. But it's worth noting the stock moves. The one thing I want to point out is we've all heard about the crash of 87. And some of us might think that 1987 was a negative year. It was not. The stock market ended up 5.81%. In 1987, the stock market had a very high rally going into August. It peaked in August and started coming down a little bit. And then on October 19th, 1987, it crashed. But it didn't, and then it recovered. So from October 19th to December 31st, the market actually caught itself, recovered, and ended up 5.81%. It was not the disaster that you might think it was. We had and then you can see that some of these returns are phenomenal when you go year by year. Late 90s, of course, was the dot-com bubble. Everybody was buying stocks. People couldn't get enough of stocks regardless of earnings. And then, of course, the stock bubble burst in the early 2000s. We go into 2007, 8, 9, and you will note that that was one of the worst periods in the history of the stock market, and it really wasn't all that bad. But it was bad, but it wasn't the end of the world, and in fact, the markets came back. So most recent years, the market has done very, very well. Arguably a little bit too well, starting in 2012, 16% return, 2013 a 32% return, 2014 13.5%, and on and on and on. 2018 had a negative year, which was probably somewhat of a little bit of pressure being taken out of the market, which is often a good thing. But the last few years have been phenomenal. We've been on a phenomenal ride. So that's sort of where we're at. Let's take a look back at what the stock market has done in the past. I'm going to use the S&P 500 as a proxy for the general market. There's some reasons why you don't use that because of the weighting, but it's let's just go with the S&P 500. It dates back to the 1920s, but the 500 stock index has been around since 1957, and I think that gives us a good idea of the market as a whole. It's not 30 stocks, which is the Dow, and it's not 5,000 stocks like the Wilshire. But let's use the S&P 500. There's some good information, historical information using that. So here we go. The average annualized return since inception in 1926 has been 10.49%, and during the modern era in 1957, the average has been 10.67% up to December 31st, 2001. Now you might see in certain literature that number being, a few basis points off, but the number 10.67% is what I've seen more often in the literature. Now I want to compare that 10.67% return with what has actually happened. So the question is, are we above average or below average? And again, I'm trying to slip in as much good news as I can in light of this start of this bear market. Let's take a look in a 10-year period. If you had money in an investment vehicle earning 10.67%, how much would you have at the end of a 10-year period? Well, it turns out if you put it in your calculator, you're going to end up with $275,612. And that's a great return, 10.67. It certainly beats a savings account, T-bills, and any interest rate vehicle. Now, how did we actually do? I'm using the numbers from the chart before, where in 2012 we had a 15.8% return, 2013 at 32.15, etc. Now, you might argue, I know I'm picking a good 10-year period, and I'm doing that on purpose because I want to show you that things may not be as bad as we might think when we look at this bear market. So if we use actual numbers and we compound them, so if we put in $100,000 the first year, we have $115,890. And we're above the 10.6, we're above average. And of course, we're going to be above average for the entire time and almost to a doubling. So the market, if you had stuck $100,000 in, you'd be somewhere around $456,500. So I'm going to call that a bonus of $181,000. And that's one way we can look at it. We can say we're way ahead of the game. So the problem is we're all human and we tend to sort of grow into our high water marks. We tend to have an expectation that this will always go on. But what I want to remind us of is that there's an average here of 10.67% return. So if we've earned more than that, and this happens to be about 16.5% return, by the way, that we've earned over the prior 10 years. If we earn more than that and things start coming down like they've come down in 2022, maybe it's not so much that we should freak out about that, but we should count our blessings and say, you know what, we've got a buffer here. We're doing okay. In fact, in this next slide, I just want to suggest to you that let's say we have that sort of moderate average sort of slide. Remember, because we went into this a little bit quicker than average, in theory, we might have a sort of moderate bear market. I'm going to call it 30% just to make the math easy. But if we have a bear market of 30%, so our stock values, our stock portion of our portfolio is at 70% of the value of December 31, where does that put us? Well, that puts us as right about $320,000. Guess what? We're still ahead of the game. We actually, not only have we not lost money if we've been in the market for 10 years, but we're ahead by $16,000 over the average. And we still have a lot of room to move before we really even lose money, a good $16,000, $16,500. So the lesson I want to get across here, I'm not telling everybody to stay in the stock market. I think there are some people who probably should not be in the stock market, or not to the extent they are. And over time and in changing circumstances, you may want to be more or less in the stock market. But what I'm telling you is this recent bear market, one of the problems is that people do get a little emotional. They get attached to their high water mark, the $456,000 number. They grow into it. Their spending habits grow into that higher number, when in fact we know there's probably going to be negative years. We know this from history. And I don't even know if I want to call it a reversion to the mean, but let's call it a reversion to the mean, getting back to that 10.67. Maybe our problem is expecting that the world has changed and gotten away from this 10.67. So we need to be reminded that these periods where we're earning 16.5% over 10 years is a little bit abnormal, and maybe we should set our sights and our expectations back to our normal 10.67. Here's an interesting statistic. Mark Holbert, if you don't know Mark Holbert, he's great. I think he admits he's a contrarian. He loves to bring out statistics about when to buy, and that's usually when everybody else is selling. The so-called buy when there's blood in the streets, buy when everybody else is panicking and selling off their stock. And he's got statistics that'll show you that you can make a lot of money by buying when other people are selling and perhaps selling when other people are buying. So, and that's not really rocket science. That just makes sense. You buy low and sell high, not the other way around. Now, he had an article recently that you can look up, and it showed that on average, once again, we're talking averages, those who buy stocks the day the S&P 500 enters a bear market have made 22.7% in the next 12 months. So let's just say that you're a little worried about the stock market. You're kind of in that emotional, you're in that freak out mode. You're worried. You're going to take your money out of the stock market. Where are you going to put it? Well, let's take a look at the world. Let's see, what can we do with that money? There's a couple of things, I suppose. You could try to time the market. And there's not enough time here to go through, but timing in the market, if you Google timing market fools, you will get lots of articles about people who have tried to time the market. You'll get lots of articles about how foolish it is to try to time the market. So let's say you're going to take this out. What better place can you think of than putting it in and earning 22.7% on average? That's another way of saying don't take the money out. If the market is right for you, I want to emphasize, it may be that the stock market isn't right for you for either financial reasons or emotional reasons. So this is a good time to review. And in this next slide, I have sort of summarized where we should be. We're in a bear market. We've gone down 21% on the S&P 500. Things are looking bad. There's a lot of bad news. There's a lot of bad headlines about inflation, about the Federal Reserve raising interest rates. Rising interest rates causes stocks to go down. Rising interest rates causes there to be recessions. Rising interest rates cause bonds to go down. So first of all, we need to relax. And we just need to, just think for a minute, hold off. Do not make any rash decisions. That is not to say you shouldn't be thinking about getting out of the stock market, but not because the stock market is down. It may be that what you have in the stock market is not the right money. So just relax, review your goals and your plan. Maybe some things have changed. Maybe you have a short-term need for funds. Short-term money does not belong in the stock market. As we've seen in our charts, there are periods of time when the stock market is down substantially, and if you happen to need your money during that period, you're going to have a loss. If, on the other hand, you have long-term money dedicated to a diversified portfolio, definitely some of that belongs in the stock market. Maybe a large portion, but it all depends on a review of your personal goals and your plan. If you are going to stay with your plan or build a new plan, you may want to do some rebalancing. So a rise or fall in one of your asset classes causes your portfolio to be out of balance. And let's say originally you set a goal of 60% stocks and 40% bonds. Stocks go down significantly. So now stocks represent 50% of the value of your portfolio. What you're going to do is you're going to sell bonds to buy some stocks to get your allocation back to 60-40. That doesn't necessarily mean your assets are going to be greater in value, but there are some interesting things that happen when you rebalance. It forces dollar cost averaging. So it forces you to buy things at lower prices. So those things that rise in value, you sell off and you buy things that have gone down in value. And therefore your costs of those things that have gone down are averaged down. Your average cost is lower. Another interesting thing that occurs when you rebalance is that since you're buying additional stocks at lower prices, remember we talked about that recovery period. Well, now that you own more shares of stock, your recovery period is actually shortened because you're not sitting around waiting for that set number of shares to come back to break even. Now you've got more shares working for you, and when those more shares start rallying, they will get back to break even sooner than they otherwise would have. Here's a very quick example of a rebalancing. So let's say initially, and I'm going to change a little bit from what I said earlier, you have US stocks at 40%, international stocks at 20%, fixed income 20% of your portfolio, real estate, and by that I mean equity real estate types investments, REITs, and some exchange traded funds. And then you have some alternative investments, which might include metals, it might include even commodity type exchange traded funds, and that's usually a small part of your portfolio. So your initial allocation was this: you have $300,000, so you can see your allocation here, 120 in stocks. Now let's say stocks go down 20%. Now you're sitting on $96,000 of stocks. International stocks go down 15%. Bonds go down 10%. But your real estate and your alternatives have gone up. Your real estate investment trust through either dividends or growth since the year, even with corrections, are up for the year. Your alternative, it's true that things like gold and silver ETFs are about break even, but there are some other alternatives that have gone up in value. Now what you do is you rebalance. So we want to get back to 40% stocks. We've got to add $12,300. We've got to sell some of these winners and buy some of your losers. And what we're doing when we buy this $12,300 worth of stock is we are going back to the 40%, but remember we have more shares now. We started with a certain number of shares of US stocks. Now we're buying more. We're rebalancing. And it may be that through a bear market, you may have to rebalance again. But we're dollar cost averaging, and we're shortening that recovery time when US stocks do go up. Likewise, international and fixed income. Hey, thanks for listening. I look forward to putting out more wealth talks in the very near future. You can check out my website, radiopete.com, for more podcasts and my blog. I do want to remind you that the foregoing pages are illustrative purpose only. They have hypothetical data. They are not personal to you. There are certain assumptions that have been made, and a true risk assessment and investment profile should be done between you and your professional legal, financial, and tax advisors. So please take care, please stay healthy, please stay wealthy, and listen to Radio Pete to stay wise.